A wonderful client, Ernest DeBella, asked a great question that I was able to dig into. Here's the question. With the rule change to take place in China barring rehypothecation, will that influence the United States and other countries to follow suit? And if so, does it create upward or downward price pressure? That is a fabulous question, something that we've kind of been talking about since January of 2005. But before I dig into it, let's just make sure that everybody understands what hypothecation and rehypothecation is. Hypothecation is using equity to borrow and take on debt and leverage. Rehypothecation is using that same equity over and over and over again. If a bank does this transaction through the City of London, there are no limitations on how many times that same equity can be used to borrow. So keep that in mind. It's a little bit of equity with a whole lot of leverage on top. Now let's just dig right in, because markets, you can think of them a lot like bridges. And when a bridge is brand new, everyone trusts it. Cars fly across it. Nobody thinks twice. But frankly, over time, cracks start to form. The steel fatigues. The weight increases. And at first, the engineers don't rebuild the bridge. They just post new rules. Slow down, no heavy trucks, single traffic only, etc. But quite honestly, those aren't repairs. Those are warnings. And today, we're going to talk about a warning that the global gold market just received. Thank you so much for asking this question, because it's one that tells us that the old bridge, the paper gold bridge, well, it's no longer safe to drive on. And I'm glad about that. So let's just take a look again. With the rule change in China, barring that rehypothecation, will that influence the U.S. and other countries to follow? And does it create upward or downward pressure? Well, this is a powerful question because it goes straight to the heart of the shift that we've been talking about, again, since January 2025. The shift from paper price discovery to physical price discovery. Paper markets, you can create as much as you want. Physical, there's a finite amount. And China just took the first visible step. So let me show you what I mean. To understand the impact, we have to start with what China actually did. And that was to put a soft ban on their markets. It's a crackdown on behavior, banning leverage gold deals, price fixing, and cracking down on illegal trading, as well as tightening control over those gold flows and reducing that synthetic exposure. Works great on the way up. It's awful on the way down. But this is how China always moves. They don't announce a revolution. They start to change the behavior first, and then the rules follow later after they create new habits. And we already have proof, because this isn't theoretical. It's happening. Look at this headline. In Shenzhen, one of China's major financial hubs, cracked down on illegal gold trading, banning price fixing, and leverage deals. It's the first domino. This is the soft ban in real time, and it's already in place. In fact, it went in place that same day that they announced it. And once China starts tightening behavior, frankly, that next step is predictable. Because after you restrict behavior, you restrict and change the structure. And so the next part would be limits on rehypothecation, caps on leverage, mandatory physical backing, and China is already signaling this direction. This would be a partial ban. So first was the soft ban, that's already in place. Next is the partial ban, and that's where China begins normalizing physical-only practices. So they put limits on that rehypothecation. Instead of unlimited, there are now limits. They put caps on how much leverage you can put in. They put in restrictions on foreign banks, and there's mandatory physical backing. This hasn't happened yet. That's just the next step. But this is where the system starts shifting from the synthetic, all that money printing, to the real. And once you normalize physical-only practices, well, there is only one place left to go. Because once the market is trained to operate physically, then China can formalize the rule. So, in a full ban, there would be no rehypothecation, fully allocated only. That means that the gold is there for delivery. And here you go, physical settlement is required. And what does that do? Well, China becomes the global physical price hub. We've been talking for years about the financial power shifting from the West, from the US to the East, to China, and this would certainly put them in a position because the full ban is the structural break. No rehypothecation, fully allocated only, physical settlement required. There you go. This is the moment where price discovery moves east and away from those paper markets where they can create as much gold that, or silver too, that does not or ever will exist as they want to. But the physical only markets, there's a finite amount. And that brings us back to the viewer's question. Will the US and other countries follow? Well, the answer is likely not immediately, but ultimately they won't have a choice because China becomes the trusted settlement hub, a reliable pricing center, and a magnet for global gold flows. And that directly challenges the Western dominance in gold pricing. And when the market starts trusting China's physical price more than the West's paper price, well, the West will be forced to respond. And even if they don't ban rehypothecation, the market will start pricing in the difference. And that leads us to the next piece. Because once you have two different systems, you get two different prices. And a global physical-only repricing, frankly, that becomes absolutely unavoidable. Why? Because physical gold trades at one value and synthetic gold trades at another. Because there is a finite amount of this, but an unlimited amount of this. And when the physical market becomes the dominant price setter, everything reprices upward to match the reality. Because, you know, when the synthetic system tightens, the pressure doesn't disappear, it just shifts. Which brings us to the second part of the viewer's question. Does this create upward or downward price pressure? So let's just take a look at that. This shift tightens physical supply, and it weakens synthetic supply. It shifts price discovery to the east, like we've been seeing with the premiums, and it creates upward pressure on all of the gold and silver contracts as well. This is not a dip-driven market anymore. Buy the dip, buy the dip. We've been trained to do that. This, my friends, is a structural repricing, and something we've been talking about for over a year now. And that brings us to a related question from another viewer, because this shift doesn't just affect bullion, it affects everything tied to gold. So Koki8008 asks, you often refer to pre-1933 coins as these have not been the subject of confiscation, but all coins were pre-33 then, or not? Well, yeah, they were. Any coin that was minted prior to 1933 would indeed be a pre-33 coin. So the question is, could you please provide any historical data about confiscation in Europe? And we're going to come back to the pre-33s in just a minute. So here you go. Now, we've talked about this before, but throughout Europe and the UK during periods of crisis, though this has happened throughout the world, which I've shown you many times before, just focused in on Europe and the UK for the moment. But in these cases, citizens were required to hand in gold coins, private ownership was either restricted or banned, and jewelry and coins were surrendered to the state. Only certain historical coins were exempt. And here's the key insight. Governments have always targeted the easiest gold to seize, which are bullion and modern coins. That's what most people, if they own gold, they hold it in their IRAs. And that is the easiest gold to take. But older collectible pre-33 coins, they fall outside of that net, because it's in a completely different classification. That's what I want. And this is why the form matters. This is why history matters. And this is why collectibles behave differently, because this is a physical only market. I'm going to show you this in just a second, but look at this performance data because it goes into another viewer question, which was, how does spot gold affect collectible coins? Well, frankly, this is an absolutely perfect moment to clarify something essential. Spot gold is a paper signal. Collectible gold is a physical reality. And as price discovery shifts from paper to the physical, the gap between the two widens. Okay, so what we are looking at here is spot gold contracts versus pre-1933 common date coins versus PCGS 3000 versus better date or more rare coins. And when you look at the long-term performance, you can see that as spot gold rises, the very common date coins, your bullion, just your raw gold, well, it does the same thing. It basically, those two lines overlap. But when you get into, say, a common date, which would be like a 1904 or something like that, well, those kind of follow suit too, simply because there's more of them until you get into the PCGS 3000. That, as you can see, rises even more. That's that green line, and it rises even more. But the better date coins, so the most rare of them, they outperform them all. Why? Because collectibles are pure physical scarcity, and it works kind of like this. Let's say there's an auction, and there are 10 coins on a table, and there are 10 people at that auction, and everybody wants one. So wherever the bidding opens, that's what they're going to pay. But with a rare coin, there's still 10 people there. There's only one of them, and everybody wants it. So whoever is able to pay the most for it or is willing to pay the most for it, they're the ones that get it, but you still have 9 other people that wanted it. So collectibles, as pure physical scarcity, they don't care about paper markets, and they don't care about leverage, and they really don't care about rehypothecation because they don't participate in it. They respond to real demand and real supply. And as the world shifts to physical price discovery, scarcity wins. So let's go back full circle. And remember that bridge analogy? Well, when the old bridge starts cracking, the engineers don't rebuild it overnight. We see the problems with infrastructure. They post warnings, they restrict traffic, they slow everything down. But eventually, the weight becomes too much, and the bridge that once carried the world's traffic, no longer the bridge that the world trusts. And that's where we are today. That paper gold bridge is cracking, and China is already rerouting the traffic to the physical bridge. And the rest of the world, they're going to have to follow. Not because they want to. They make a whole lot more money, or appear to make a whole lot more money when they use this garbage, but because they don't have any choice. They have to. So here's what you do. You get yourself positioned in the physical start of this transition. Go ahead, give us a call and set up that time to talk with our strategy specialists and get your strategy in place. Then you build your portfolio based upon your goals. Now, you've got to do what you're comfortable with, regardless of what anybody says, but you can see, and honestly, confiscation has happened so many times in the past. In the US, I counted 777. So you want the collectibles. That's why I go with the collectibles. I can't guarantee that they will or will not do an overt confiscation, but quite frankly, desperate governments do desperate things, and they've been covertly confiscating your work and your wealth since the day you were born. Go on to the Federal Reserve Department's, the FRED, F-R-E-D, the Education Department, pull up purchasing power of the consumer dollar, put your birth date in there. You can see what the Federal Reserve itself is telling you, how they have robbed you by doing this. So you want to build your collectibles and your gold and your silver portfolio based upon your goals. And you build your community so that you can create surety in food, water, energy, security, barterability, wealth preservation. Community is critical, and shelter to make your last stand. You build your sovereignty, and you do it before the rest of the world realizes that the bridge has already shifted. Because once price discovery moves to the physical, it ain't moving back. And you need to be fully in place when that happens. And the other thing that we need to make sure that happens is that we get redeemable gold back in the system again. Because the public must take the gold back. They must. And we must. We must take our power back. And we can do it if we come together. So until next we meet, thank you for the questions. Keep them coming, because I'll look at them. If I'm not fully familiar with it, I will absolutely look at it. So I appreciate all of the input that you guys give me. And until next we meet, because we're a team and we're in this together, be safe out there. Bye-bye.